Hello.
Hello.
So, Stuart, now more than ever before, people are realising it would be a really good idea to have an emergency fund. Have you got any ideas of what can you do if you haven't got a stash of cash?
Yes, I mean, obviously, the current crisis has highlighted the advantage of having an emergency fund, and stereotypically that is 6 months of cash sitting in a deposit account, and with the base rate at 0.1%, obviously it won't be earning very much. If you haven't got that stash of cash, if you like, there are a couple of options that might be available to you. If you're older, specifically over 55, you might be able to withdraw some tax-free cash from your pension. The thing you've got to look out for there is that obviously when times are better, you might want to start making contributions to your pension again. But there are a couple of little niggles, one that can help you and one that can be a bit of a bear trap. The bear trap is that if you withdraw more than your 25% tax-free cash, your so-called money purchase annual allowance, the amount you're able to put in each year, can drop from 40,000 a year down to just 4,000 a year. Now that might not be an issue for you, but it's something to be aware of.
It's a big difference.
It is a big difference. So,
yeah.
so if your circumstances are temporarily straightened, so you've been made redundant in your late 50s and you need a little bit to get you by, but you intend to fully replace it, obviously don't take more than tax-free cash. And in these circumstances, do take financial advice as well, because this is a very complex area. These are just general guidelines. The other thing that might help you is that the 25% rule doesn't apply to very small pots. So say over your lifetime you've accumulated several pension pots, one of which is below £10,000, you can generally withdraw that.
So how about if you're a bit younger?
If you're
maybe you haven't got a whole load of pension.
Yes, yeah, very much. So if you're younger, the ideal vehicle for this in many senses is the lifetime ISA. Lifetime ISA basically gives you a 25% bonus if you save the money either as to contribute to your first property purchase or towards your retirement.
Okay, what are your age constraints on that then?
The age constraints are you can open a lifetime ISA until you're 40, and having done it before your 40th birthday, you can then contribute until you're 50.
Uh-huh.
So basically, if you withdrew from a lifetime ISA, you'd lose your bonus, but just as in the way that if you add a 25% bonus to something to give you a larger number, and then you take away 25%, which is how it used to work, you actually end up losing, trust me on the math, 6.25%. Now, until the 5th of April next year, recognising the extraordinary times in which we're living, that penalty has been removed. So you lose the bonus, but effectively you're in no worse a position than if you'd put money in a normal ISA.
Yeah, so that sounds like a really good option then, because you've still got time to make it up as well, haven't you?
Yes, you've got until your 50th birthday to make it up, and it is money you can tap relatively readily.
Well, good idea. So, looking at the other way round, if you were looking to build an emergency fund, what are the best sort of things that you should do? I mean, especially since putting something in the building society, earning money is not where you want to keep your savings. So what could you do?
No, yeah, okay. If you're looking to build in an emergency fund, and many people, because of lockdown, have still been earning the same amount of money or broadly similar, but have had fewer opportunities to spend it. So now is the ideal time to be thinking about emergency funds. Again, the pension route and the lifetime ISA route are worth considering, because with the pension route you get tax relief at your marginal tax rate. So if you're paying 20% tax, you get 20% tax relief, and if you're 40 or 45% tax paying,
you obviously
yes,
make a lot more money out of the inland revenue.
So do you see what I mean? If you're old enough to be able to count it as more liquid, then that might be an avenue worth considering. With a lifetime ISA, you get a 25% bonus if you use it towards the purposes for which it was designed, the house purchase or for retirement. But there are a couple of other things you might want to look at as well, because obviously if you're saving money but you've also got a lot of debt, especially if it's expensive credit card debt, you could actually be giving yourself the financial flexibility for an emergency by actually focusing on paying down the credit card debt rather than saving a separate amount. So on the one hand, you're paying a lot of interest on your credit card, and on the other, you're getting very little interest on your deposit account. So that can be one way of creating a bit more financial flexibility to withstand a downturn. And the other option is, if you're in a situation where you're either thinking of buying a house or you've already got a house, an offset mortgage can be a very good and flexible option here as well. Because
explain what an offset mortgage is. Yes.
A traditional mortgage is where you pay the mortgage, you pay the principal and the interest back every month. With an offset mortgage, what you have is a mortgage account on the one hand, but you also have a savings deposit account, if you like, on the other hand. And whatever is in that deposit account is offset against your mortgage. So say you had a £100,000 mortgage, but you had £50,000 in your offset account. The way the arrangement would work is you'd only pay interest on the 50% outstanding, the £50,000 outstanding, not the whole £100,000. So you save yourself a bunch of interest. But the best thing about it in terms of emergency planning is that if you overpay an offset mortgage, so the savings account builds up and say perhaps it's 75% of your outstanding balance, you can then take the money back if you need it in an emergency. Whereas with a traditional mortgage, if you overpay it, you can't really go back to the bank or the building society and say you want the money back, especially if you've got no income at that particular point because you're just being made redundant. But if it's an offset mortgage, you absolutely can do that. So that's a very sort of powerful tool for future planning. Obviously, it's not much use if you haven't got a mortgage at the moment and you haven't got a sort of a fund at the moment. But it's a very flexible way of giving yourself financial flexibility without just having it sitting there in a deposit account earning nothing.
Yeah, that sounds like a good idea. If you were just entering the property market, how likely would you be able to get an offset mortgage as opposed to a normal one?
Well, there are several providers out there who have always supplied offset mortgages, and it's always been a very attractive product for people who have perhaps more uneven income streams anyway.
Which is portfolio working.
Which is portfolio working anyway.
Yeah,
yes.
Definitely.
So basically, what we're looking at is a situation. We've come up with 4 tools that can help you to withstand a financial emergency. One is using pension savings, one is using a lifetime ISA, one is giving yourself headroom on your debt by paying down credit card debt, and the other is a variation on that theme but having an offset mortgage that allows you to overpay and then take the money back when you want to. And the best of all is that all 4 of those methods, should disaster not strike, you get tax relief on the mortgage, you get a 25% bonus on the lifetime ISA, you save yourself a bunch of interest on your credit card, and the offset mortgage could mean that you pay your mortgage off years or even a decade ahead of schedule.
Sounds really good.
Yeah, so it's a kind of win-win. You know, if you need the money, it's there. If you don't, you get rewarded for it. So we hope you found this useful. If so, please subscribe, ring the bell, make a comment below if you've got any queries, questions or ideas for future shows. Otherwise, until next time, take care out there.